Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be doing a weekly wrap-up of all of the S&P 500 sectors. So jumping right in, obviously we're going to start off with technologies. First thing I want you to pay attention to in this technology chart, XLK, is notice we're at resistance. Now, technically speaking, we're above all of the key weekly moving average. So this is actually a bullish chart as we are currently analyzing it. So what can we expect for this price action? Well, considering we're at a major resistance point where you arguably had a big breakdown gap over here, 2 weeks of consolidation, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, roughly 14 to 16 weeks throughout this whole consolidation point where you were chopping in, you had big reversals, but roughly 16 weeks of price action in around this blue box. So naturally speaking, 3 weeks of consolidation is not enough, but it's a start. It's actually a very healthy start for technology. And right now, you do have to favor the upside bias for XLK because it is starting to put in a little weekly bull flag pattern. Just like it did over here, where you had 1, 2, 3, 4, 5, 6 weeks of consolidation before you had your impulse green bar breakout. You need to see way more than 6 weeks of consolidation because of the fact that you have had way more price action trade in this resistance zone. So therefore, in order for this to be a sustainable staircase pattern up, we need more consolidation. But notice how the consolidation is probably going to take you somewhere to the apex. I do believe we're in for a capital rotation out of the mega cap tech, out of the technology fund. Technology fund on the year-to-date performance is up over 18.74%. So clearly it's had a magnificent rally just in the first quarter and beginning of quarter two alone. In terms of its 1 year performance, 365, technology is actually still down 1.53%. So it hasn't actually completely captured that 1 year trend yet, which is why we have to be very careful about going long technology in this particular environment. Now, if we were to get more consolidation patterns, it does favor an inevitable move to the upside. And I've actually started making a list of some of the technology names. One of the reasons why we've been such a choppy market is I went through a bunch of technology names in the XLK, and we're looking at ADP for a potential short opportunity. I have that one on my radar for a potential. You can see that it's broken this key trend line. Now we're looking for bearish pattern, more bearish consolidation. I'm looking at NOW for a long play. Basically, we have a potential inverse head and shoulders here. If it can break out of this neckline, that could bode well for a bullish move to the upside. FISV, I'm looking for a retrace lower to see if we can go long on this particular name because it's been clear that it's broken out of this trend. You had a big impulse move, a hard sell-off back to support, and you're still holding that. So I would wait for a retrace lower to get back in on the long side. LRCX is a strong name that I'm watching. You see this beautiful left shoulder, head, right shoulder breakout. So there's a lot of pockets of strength. You look at MU for a short. MU is one of my top prime candidates. It's actually putting in bearish consolidation. I think the semiconductors are about to break down. A couple other names are SNPS for a short, MPWR for a short, for a long, ADSK for a short, MCHP. I'm looking for a potential long trade. We're looking at NXPI for a potential long as well, KEYS for a potential short trade. You can see there's tons of weakness there. WDC for a potential short off of more bearish pattern. And then also finally CDW for bearish short off of more bearish pattern. So clearly in terms of technology, there's a lot of strength, but there's also a lot of weakness, which is why I think it's going to be very choppy as we continue to move forward. And obviously technology is still the heaviest weighted sector. But as of now, if we really start to see mega cap rotation, and I mean, just on the week, this next week that we're heading into, roughly 42% of the S&P 500 is reporting earnings next week. So we are likely going to get a big directional trend change based off of next week. When you have 42% of the companies in the S&P reporting, that is behemoth amount of earnings and lots of volatility, both probably to the upside and to the downside as companies gap up and gap down. And then not only do we have earnings, but we have a jam-packed economic data. We have Thursday we have GDP, Friday PCE. There's also a couple other initial job loss claims mixed in at the beginning of the week. Personal consumption, durable good order, new home sales, Case-Shiller, S&P. So tons and tons of economic data to throw into the mix of the earnings. So it should be very, very wild. But nonetheless, pay attention to the leading sector, technology, because it is still continuing to hold up very well, and it is consolidating at this point in time, which it needs more of. Healthcare. Healthcare looks very overbought to me, but you've definitely seen a flee to safety in healthcare. Healthcare XLV has recaptured all of the key moving averages, so that is extremely important to see. Obviously, if you follow some of the names like UNH in this particular sector, they are showing some potential bearish patterns that may be playing out. That's not a nasty, that's not a bullish candle. The fact that you actually got actually still closed with inside this green candle, but that is a definite bearish candle that we have to pay attention to see if we can get more downside on United Health, because that is one of the bigger plays in this particular sector. Even if you look at J&J, J&J is actually triggering a bearish formation here, retracing to this neckline, slowly getting rejected. The big question is, can we get above that, or do we get rejected and continue to see more downside? If you can get above, you're going to challenge this gap fill. If you keep getting rejected, there's a chance that we go all the way down to 135. But in terms of healthcare, because people have fleed to this particular sector as a flight to safety, you just have to be cautious about more of the riskier sectors like technology. I mean, typically when you see healthcare start to outperform, you generally will see money move out of, say, technology, which could be on the near-term precipice of happening. Let's take a look at XLF. XLF, in terms of its 1-year performance, is still down minus 12.26%. In terms of its year-to-date since the start of January 2023, it is just roughly down minus 2.87%. So it's starting to come back, but definitely still a lot of weakness in the financial sector. And obviously one thing I want you to pay attention to is look what resistance point we're at. We're at this upsloping COVID trend line. That is the big level to beat. If technology can start to get, or if financials can get above that, then you're likely going to attack this red bar high. But that red bar high is an extreme amount of resistance that is not going to be very, very easy to get through in kind of the next coming weeks. It would take probably several weeks to try to recapture and get through that. And obviously there's still a few financials to report. And then obviously if interest rates start upticking, which I am anticipating over the coming weeks, then we're obviously going to see more pressure on some of the financial margins. You know, so definitely pay attention to some of the leaders like Bank of America, Wells Fargo, JP Morgan, of course, is extremely important, Berkshire, and then there was a little bit of insider information that BlackRock CEO dumped a whole host of shares last week. Basically, I think it was 7% of his whole portfolio in BlackRock. So that is an extreme amount of selling from a very, very influential person in BlackRock. And just what I want you to pay attention to is this is a very bearish stock in my opinion. Actually, one of the financials that I'm looking to short in the coming weeks. I'm just hoping to let a little bit more time pass to clear up all the financial earnings. But one of the reasons I'm looking to short this particular BlackRock stock is you have the insider selling from the CEO. But take a look at this green bar. This was your bullish move up, recapturing this high. All of this was bullish consolidation up until this point here. You got a bearish weekly close below this green bar. Now what you've done is you've retraced over several weeks and you keep getting rejected. So the level I'm watching for now, if we get another weekly close, I'm even tempted to short it here. I haven't, full disclosure, but I am looking at this particular name. If we get another close below this green bar low here, this stock likely heads back down to 560, and that would be a nice little short opportunity that I'm keeping an eye on for myself and for my members. Let's move on to the consumer discretionary fund. XLY is actually one of the sectors I'm looking for potentially more of a bullish play. One of the reasons I'm looking at XLY is, let me just erase some of these trend lines. Basically, you can see you're starting to recapture some of the short-term moving average. But the pattern I'm looking for, now keep in mind it hasn't triggered, but this is the pattern I am looking for. This beautiful little inverse head and shoulders. And basically, if we can get a weekly close back above this neckline, this breakout zone over here, and preferably the 200 weekly, then this is a primed candidate to look on the long side of trades once you get a little bit of consolidation in the pattern. But definitely pay attention to the XLY because it has been beaten up in terms of its 1 year performance. Consumer discretionary has been the second worst performing sector over the 1 year period, not down 19.68%. And then in terms of its year-to-date performance, so since the start of the year, XLY is up 14.1. So it's definitely been one of the more stronger sectors to pay attention to and to be invested in. Obviously, some of the names are like Amazon, Tesla, Home Depot, Nike, McDonald's, Starbucks. But again, this pattern hasn't triggered, so it could be a failed bullish pattern. If you get a failed bullish pattern and you don't get a breakout from here, you're likely going to test this 1 year moving average, the 1 year weekly moving average, which is this orange trend line over here. It may coincide with the double bottom. But some of the important stocks to pay attention to, like Tesla, and why that particular ETF is going to be so volatile. If you simply look at Tesla's chart, Tesla obviously had a massive move down on earnings, big gap down. As of now, you're still holding this support, so that is a short-term positive. And you actually, on a weekly close, held this support. So believe it or not, Tesla could actually continue to move higher, which is why I think that this XLY ETF could also be on the precipice of breaking out. When you factor in Tesla and Amazon are the two biggest stocks in that particular ETF, and Amazon actually looks a little bit more poised to continue the upside move as well. And if you just simply look at Amazon's chart, make a downsloping trend line, simple as that, you can see you've recaptured the key moving averages. Amazon is showing a great deal of relative strength right now in terms of the sector, in terms of stock in this specific sector, but it is one of the more beaten down mega caps. Now, Amazon is still wielding such a heavy multiple in comparison to its other mega cap peers, but it's one of those stocks that we'll just continue to see if it can hold its PE. You know, its forward PE today in Amazon is 74x, 74 times forward PE. That is an extreme multiple even for a bear market. And then if you look at the start of the year, it was trading at a 51 PE. So it's clearly bounced significantly off the lows, but the earnings for this stock are going to be telling. And right now you do have a potential breakout. The big level still to clear above this weekly reversal, and you're at this weekly 50 moving average, but nonetheless this chart is looking poised to continue to break out. And notice how you do have this little left shoulder, a head, a right shoulder. You can argue to say you have broken out, and really the upside target on this pattern takes you to about 135, 140. Now, will it get there? Will it complete the fully measured move? Time will tell. But if you look at Amazon, it's broken out of its inverse. And then you look at the XLY, it's on the near-term pattern of trying to break out. So really, if Tesla can start to hold and bounce off of this level, and I'm actually looking at Tesla for a long, believe it or not, a lot of people are hopping on the Tesla train for a short, but considering it held this key pivot, even after a vicious poor earnings performance, even though it was kind of a beat on the actual earnings but a miss on the revenue, it really wasn't that positive in terms of guidance and what the overall outlook was, in the sense that Tesla has started cutting prices significantly, and they really didn't come in with that great gangbuster sales. So nonetheless, Tesla's a difficult one to play at this point in time. We've got to see more pattern consolidation. If this puts in a bear pattern, it will likely make a move lower to the gap. But considering it didn't close below this, that's actually a short-term bullish sign for Tesla at the moment. But let's see what next week has in store. If you get another weekly close below these key moving averages, then there is a very strong chance you can go and test this 365-week moving average on Tesla. All right, let's do communications sector right now. So XLC, you can clearly see, is at resistance, your COVID trend, but it's also trying to break out of this basing formation, this inverse head and shoulders, also a kind of a cup and handle pattern. And if it can break out and get above this neckline, this sector has a lot of upside in communications. In terms of communications, its 1 year 365-day performance is down minus 12.63%, but it is the best performing sector still year to date. It's up 20.21%, so clearly having a beautiful move off of the January lows from here and really staying at the the high of the chart. Now, communications, we have to be very, very careful because this is one of the sectors that are arguably the most skewed in terms of having one stock over 20% weighting in the particular indice. Meta, that stock is Meta. Meta has had a beautiful run. Meta is into this massive resistance. Meta is starting to see a bearish crossover in the key 100 and 200. Meta is overbought in the short term. And realistically speaking, Meta has hitting some key resistance on really the monthly chart of this pattern, which I think is very interesting and telling to pay attention to. So Meta's at some resistance. We'll see if Meta has a good earnings report. Zuckerberg, Meta has been slicing and dicing all of the job cuts. They've been cutting jobs left, right, and center, clearly trying to remove the dead weight. So that's one of the reasons why market participants have been so bullish on Meta at this point in time, obviously VR. But needless to say, when this stock has a 20% weighting in the communications sector, you can clearly see how much Meta has moved off the lows in comparison to the XLC, which means that there's so much relative weakness in the XLC. I mean, if you just simply look at some stocks like Charter, this is a bearish pattern that I'm looking to short. I mean, you're still stuck in a range. Typically, you can buy the low end of the range and yield a bounce and short the high end of the range. But at some point in time, this is actually starting to be a bearish pattern that could actually break lower and actually take us back to about the 260 level, or maybe even 281, and we'll see where that gets us in terms of a bounce. But lots of relative weakness in this particular sector. Even if you look at LYV, which is another one that's breaking some key ranges here. So that's another potential short trade. Obviously, if we look at Google, Google has been extremely strong as of late, holding bullish consolidation above a key moving average. And this pattern looks primed and ready to continue to break out. If you simply draw this trend line here, I would love to see a retrace back down to maybe the weekly 200 or even this downsloping trend line. And then you could actually play it on the long side for Google. But again, with Meta being extended, with Google kind of still having a little bit more room to the upside, maybe we'll see some capital rotation, say out of Meta into Google or out of Meta into some of the other communication stocks. But XLC as a whole, if capital starts to rotate out of Meta, you're going to see this XLC really start to roll over because Meta's extreme weighting in this indice. Let's move on to the industrial sector. So if we scroll out to the industrials are putting in this distribution pattern. Big move down, big move up, big move down, big move up, big move down, big move up, big move down. This is actually not healthy bullish consolidation. It is consolidation, but when you have no real consistent, it's just up, down, up, down, up, down. This is distribution at the highs of the chart. In terms of industrials, and why we have to be careful of that is because of the GDP data. If the IMF is forecasting industrials, if the IMF is forecasting GDP, worldwide GDP to shrink and decrease, as well as my overall base case and forecast expecting GDP to shrink and decrease, then industrials will definitely be hit hard. Now, in terms of industrials' one-year performance, it is holding up relatively better than most sectors in terms of its 365 days. It's holding up it's down minus 1.24% over the last 365 days. And if you look at its 2023 performance, XLI is up 2.44%. Some of the important stocks to pay attention to, which hold a great market cap, something like GE. So if you look at GE has been a rip-roaring rally stock. Massive mover. Even if you look at FedEx has had a beautiful move off of the lows. Getting a bit long in the tooth extended. You're coming up into a massive resistance point where arguably you had a bullish move up, bearish breakdown over here. So naturally, I am expecting some sellers to start to occur in this vicinity. And if you look at the XLI, it would make sense that we're seeing a lot of distribution because realistically, if you go through all of the industrial stocks, and there's quite a few in this particular sector, there's a lot of weakness under the hood, and it's really a handful at the top that are holding this real market up. I mean, the handfuls are like GE, even Boeing has been a strong one that is holding this particular sector up. Lockheed Martin, some of the defense stocks were acting well, but maybe starting to see some near-term capitulation and distribution. That is a nasty weekly hammer on Lockheed Martin. So if some of these defensive stocks in the industrial sector really start to see some downside pressure, These are some of the market leaders that have been leading this whole rally higher in the overall XLI and the S&P. So naturally, this is all bearish consolidation right now because you're inside these two bearish weekly candles over here. But if XLI can consolidate above this weekly 100, then you do have a shot to challenge this resistance point again and actually try to make a move higher. The only thing that makes me slightly bullish is that you have a weekly gap around this 105.74 level that maybe, just maybe, if the markets catch a bid and we see rotation out of technology into the industrials, then we could see the XLI fill this gap. But really, that is my max upside for XLI, and I actually have a downside target of roughly about 85, pierce of $85 on the XLI to be hit sometime in the next 2 quarters. Let's move along to the XLP. So consumer staples are seeing a flight to safety right now, and you can clearly see by this chart it's on watch for a technical breakout. Now, typically from my experience, technical breakouts don't happen when you've had a 6-week rally into a resistance. Naturally, I don't think we're going to get confirmation this next week. I think we're going to get a pullback. As a bull, you want to see the pullback hold this white trend line. If you start getting closed back inside this trend line, and specifically under these 2 weeks of consolidation, that could become a failed breakout, which would take you back to the low range of this wedge pattern. Ultimately, this pattern needs consolidation in order for a true technical breakout to occur and for it to build momentum. But if you get a downside pattern basically off of this pattern, you could look for a long trade to play the consumer staples. And typically in a environment when there's low GDP, inflation, consumer staples are a good area for market participants to hide in. In terms of consumer staples 1-year performance, let me just take a look here. Consumer staples are down minus 5.14%. And in terms of its 2023 performance, consumer staples are actually positive, holding up 2.71%. Some of the best performing stocks are like Lamb Weston, Clorox, Church & Dwight, Molson, Hershey Foods. I mean, take a look at some of these stocks. Clearly, investors are hiding out in some specific names that are really, really clear. Hershey, massive, massive breakout. I would not chase it up here, but definitely a technical breakout. Look at this one. Lamb Weston, the best performing stock in the overall consumer staples. Huge technical breakout. To think this was your COVID low sell-off, boom, big rally, big sell-off, and a massive rally making new 52-week weekly highs is certainly impressive. Even if you look at CLX over here, basically that one put in beautiful bullish consolidation, and now it is trying to break higher. And I can see that I have a couple targets still here on Clorox, but needless to say, consumer staples are on watch for a technical weekly breakout out of this wedge pattern. And if we get this breakout, then this is the sector that you want to pay attention to for bullish retraces to the downside, where you can get long a particular stock in this particular ETF. Also, some of the interesting charts are Costco, Walmart. There has been insider selling there. Costco gave some pretty weak forward guidance along with Walmart, so it leaves me slightly skeptical in this particular sector, but nonetheless, the charts are the charts, and if we get a technical breakout, we will look for consolidation plays to play the bullish side. Utilities are also on watch for a technical breakout. You can clearly see here, downsloping wedge pat or downsloping trend line. You peaked above it, had a little bit of a retrace. Now you're just consolidating. This is actually, believe it or not, very, very healthy. You're sandwiched in between 3 key weekly moving averages, the 20, the 100, and the 50. If you can actually get another 1 to 2 weeks of consolidation, utilities would be a nice sector to potentially play on the long side and just have a stop loss basically below this weekly hammer reversal, or a weekly close back inside this key trend line just stops you out of the trade. So this is beginning to look like a nice risk to reward setup, especially on the long side if we get another 1 to 2 weeks of consolidation. And there are some individual names that I'm eyeing up in the utility sector, but I'm going to hold those to my chest and really keep them for my members. But there's roughly 29 stocks in the XLU. I've been through all of them, and there are some plays both on the long and the short side, but definitely if the market breaks out, the XLU would be favorable to go long some individual stocks. Utilities 1-year performance, last 365 days down minus 9.29%. In terms of the year-to-date 2023 performance, it's down minus 1.25%. So clearly some names are lagging, but stocks like EIX, NRG, PNW are all some of the market leaders in the XLU. Let's move along to real estate XLRE. So XLRE has actually had a move off the lows, putting in bullish consolidation, trying to move higher. You're still inside this wide range red bar sell-off, so that's a short-term negative for the real estate. But you are making a series of higher lows. So here was your big low, a higher low. Now the big question is, can you actually take out this high? Or are we just going to chop in a tight range until we make a bigger directional move outside of the wedge pattern? This could basically chop from the high to the low, from the high to the low for quite a long time. Basically, I have a price point all the way till mid or the end of July where we could just be chopping in a range for real estate. And what this is telling me is that if we continue to chop in a range, it could be meaning that there's tons and tons more volatility in the interest rate market. If the yield market sees a lot more volatility, so will the real estate ETF. So definitely pay attention to that because it could be signaling some potential insider information. But nonetheless, the trend is still down. The monthly trend is not favorable at this point in time. You're actually putting in potential monthly bearish consolidation. The short-term positive, you do have a monthly hammer here and a monthly hammer over here, which are your higher lows. So realistically, you don't want to lose this monthly hammer candle around 34.50 because that is your kind of stop out area if you're trying to bottom pick this particular ETF. In terms of real estate's 1 year performance, it is the worst performing sector still, clearly down majorly from the highs. It is down minus 26.29%, so not performing well at all. So we have to pay attention to this sector because realistically, when the sectors that did bad in 2022, because they were affected by higher inflation and higher interest rates, if we start to see this trend break down even more, it could be telling us that inflation's coming back and there are going to be higher interest rates, or at least higher for longer. Full disclosure, we are shorting some commercial real estate, so we'll see if this downtrend can continue. Some of the stocks that you have to pay attention to in XLRE right now are Welltower, ticker is WELL, PLD, INVH are just some of the top 3 performers. In terms of real estate's year-to-date performance, it is up just 0.68%, so squeaking out just a small gain in 2023. Let's move along to XLB materials. So XLB is another interesting one where you're seeing not a nice consolidation pattern. You're seeing distribution. Big move down, big move up, bigger move down, smaller move up. This is distribution at its finest. You are creating this little bit of an upsloping wedge pattern. But basically, I have max resistance around the 84 Pierce, maybe 85.50, and then I do think we get a bigger directional move down. But as of now, because you got a bearish weekly close over here on this candle, this does favor a potential move lower in XLB. In terms of the materials sector, 1 year performance, it is down minus 10.68%. And just in terms of 2023's performance, it is holding up plus 3.89%. Some of the best performing stocks to pay attention to are like Nucor, NUE, just an individual name. And then you also have ECL, which is Ecolab. Let's just pay attention. Let's just take a look at some of these stocks like Nucor. Nucor's actually putting in potential bearish formation here. So this little big move down, bearish consolidation, all inside of this weekly body candle, is telling me that we should have another move down to about 130, maybe even to test this wide range reversal candle. So this is also setting up, let me just remove some of these lines here. This is also potentially setting up a little topping formation. So Nucor is one of the stocks that I'm actually watching on an individual basis for a short with my members. Full disclosure, I am very, very interested in shorting this steel stock. I've noticed actually some bearish divergence in some of the steel stocks, but if you get a trigger of this neckline, this is a very, very good risk to reward setup on the short side. And I mean, if we got a break of this pattern, this is a weekly bearish pattern that triggers and roughly takes you back down to about this 97.38 level. So you can see that would be a pretty big decline in Nucor. I mean, we're talking about from the current levels, 37%. Obviously, if you wait for the signal, you're talking about maybe a 31, 32% move down. But I'm definitely paying attention to this individual name because it's consolidating bearishly, and you do have this bearish topping formation on the weekly chart forming. So definitely keep Nucor on the radar. Steel stocks are potentially under pressure that we have to pay attention to. Obviously, there are some pockets of strength in this particular sector. I think Ecolab, let me just pull up the chart here. I haven't really paid attention to this one. This one's actually looking a little bit more bullish. So if I erase all these trend lines just to start fresh, Ecolab is actually trying to break out, and you can arguably say it has broken out. So if you take this trend line, draw it across, you have a technical breakout over here and a confirmed weekly break. This is a stock that could have a move back up to 195 based off of this accumulation breakout pattern. And this is actually at a very good, technically speaking, long level to try to pick it up on the long side, because you've had your breakout, you had your 1, 2, 3 weeks of consolidation, retest of this trend line, and you got a beautiful picture perfect bounce. How to play this is you can wait for more consolidation, or you can hop on now and just have a weekly close stop loss back below this trend line. This is one I am looking on the long side for my members, but it is one of the more bullish names in this particular sector that I am paying attention to. So lots of little nuggets in this weekly sector analysis. I'm going to continue to keep providing some information about individual plays that I am watching for my service and my members. Moving along to energy. Energy has obviously been the place to hide out. Over the 1-year performance, energy is the only sector over the last 365 days that is still positive, up 6.5% over the last 365 days. Now, in terms of energy's performance in 2023, it is actually down minus 2.85%. So it is kind of lagging the overall S&P and the Qs for now. But remember, it had that massive run up. I still, on a technical basis, although you're above the key moving averages, this is looking very, very toppy. And also I'm seeing distribution occur. And I'm actually thinking energy is going to see some near-term downside because of the fact I think oil is going to break down a little bit lower. I have it priced in that oil should see about a $70 move down, a move down to about $70, and then potentially even lower from there. Overall, if oil moves down, you're going to see energy try to break this wedge pattern again. This upsloping wedge pattern does not favor a bullish break to the upside. The probabilities favor a bearish break to the downside. And what I'm observing here is we are still inside of this weekly hard sell-off. And all I'm seeing is a big move up, big move down, bigger move up, big move down, another big move up, bigger move down. So this is very choppy, very heavy distribution occurring. What I'm seeing is off of every sell-off, all the major sell-offs. So we had our big move down, tested the 50 weekly moving average, made another big move up, didn't make a higher high. Then you had another test of the 50 weekly moving average, had a bigger bounce, made a new 52-week high, but you couldn't close above that previous weekly high. So it was just a kind of a nominal weekly high, wasn't really a true powerful one. And then you had a bigger move down, which pierced the 50 weekly moving average. And now you've had a bounce, and notice how you're just chilling above or consolidating above the 50 weekly moving average. I think we're on the near-term cusp of seeing a larger move down in XLE, which actually takes you down to the 100 weekly moving average, and it would actually break this upsloping wedge pattern. I think if XLE comes back down to this 100 weekly moving average, that is a definite buy. I would not chase it up here because I am seeing some internal distribution. Even if you look at some of the names, let's go through MRO, which has been one of the better performing energy stocks. MRO, Marathon, is starting to also see some bearish price action. So notice how MRO had this potential breakout that we're watching, and now it's looking to get clear rejection. That is not healthy right now at this point in time. Even if we look at XOM, that chart is holding up better, believe it or not, still consolidating above this key trend line, but you're really just still underneath this bearish bar breakdown. Maybe you can come up to this double top and fill the gap, but this stock is so severely bloated, even on the potential of a buyout of PXD, where you would likely see some cash or share dilution occur. Let's take a look at CTRA. That's another leader in this particular stock. If we remove some of these trend lines, You can see CTRA is starting to make lower highs over here. You're still holding this lower low over here, but this downtrend is starting to look like it's going to pick up momentum. And believe it or not, even with the big rally in oil and some of the other plays, CTRA hasn't been able to recapture and take some of the strength from the XLE sector that we've seen other individual names. Another important name is MPC, so that's been one of the best performing stocks in the entire XLE sector. And look, we've touched base on this again. MPC, Marathon Petroleum, had a bearish breakdown last week. You got a weekly close outside of this upsloping wedge pattern. So this is why I'm very skeptical about this ETF, because this is the best performing stock in XLE. So it makes sense if the best performing stock was leading the XLE higher, it's also going to be the stock that leads the XLE much lower if we see oil break down. And this could be a little bit of an insight that maybe market participants know, considering this stock had the best run in the XLE, even better than XOM. If this starts to break down, maybe there's very smart energy traders in this particular stock that knows that there's some breakdown in oil coming. Maybe it's due to recessionary fears. Maybe it's due to higher interest rates, a stronger dollar. There's certainly a lot of catalysts that could transpire. And just look at the comparison between MPC. This was your bigger sell-off in MPC. Massive surge higher, making clear 52-week highs. And then you look at XOM, also making new 52-week highs. And then you look at the entire XLE. Look at the relative weakness in the entire XLE. But then you just pick the two biggest stocks really in the XLE, MPC and XOM, and they are outperforming, clearly making much higher weekly highs in comparison to this June sell-off. So just know there is a lot of selling in the XLE that is occurring internally under the hood. On that note, I thank you all for tuning in. This video is a little bit lengthy, but there's a lot of nuggets. I've given you individual names in some of the leading sectors, lagging sectors to pay attention to, and there's going to be a lot of volatility as we head into next week. So please give this video a big like down below. If you found this information useful, please subscribe. Definitely pay attention to our channel as we're continuing to produce free content and also premium content for some of our members that I do think market participants, everyone and everywhere, should be truly aware of. Thank you all for tuning in. Enjoy the rest of your weekend, and we'll see how the rest of the week shapes up as we head into the biggest earning week for the S&P 500 next week. Thank you all. Take care.